Eliminate the noise in your trading. What on earth does it mean? Stay tuned. Hey guys, warm welcome to you. All right, so you've heard this many times before, eliminate the noise in your trading. What does it mean? And first of all, why do we want to do it? So let's just spend 30 seconds thinking about this. We want to eliminate the noise in our trading because if we have all these data points that are coming into our brain, we're going to have to use computing power, even if it's to look at it and go, it's not important, it's not important. Or it might be important, is that important? And it adds extra confusion and reduces the clarity and creates a fog over our decision-making process in trading. Our job as traders is to have as fewer data points as possible to look at and to make the decision. Which is why, often I talk about simplifying things by say, hey, okay, we're in an uptrend, I'm just going to look for longs only. Even if you're a day trader, hey, we're in an uptrend, I just want to look for longs at lows. That's the thing, and that just reduces your decision making. It reduces the cognitive load, it reduces the noise. And the danger we fall into as traders when we're first starting out is we go, right, I want everything, just give me everything. Give me a 10 screen system, right, ordered that, set it all up, right. I want a gold in there, I want to see silver, I want to see news. And we think it's a game of more information equals more profit. And ultimately it's the reverse of that. It's why I always recommend, a personal opinion of course, traders start out one screen, two screens, something like that, and just go, right, what do I need? Do I need more screens? And you may need more screens to make a decision. That's fine. I run a multi-screen system, far fewer screens than I used to, but I like having the ability to see these pieces of information that help me make the decision. But many people don't. But the point is, regardless of, we're going to piece here about screens and stuff, but it's reducing the amount of noise and not just having it for the sake of it. So what noise could you get rid of to go right back to raw data? I don't want to go down the thing of price only, but just to the perspective that, hey, I'm reducing my number of data points that I need to at least address, even if I'm discarding them. First thing is news TV. I see traders with Bloomberg on all the time in the background, and I can't see how that gives you an edge. Now listen, someone can correct me. If someone is doing 8 figures a year from Bloomberg, then I'll stand corrected, but I haven't seen somebody yet. Now, if you want it on under certain things that are interesting, like hell is breaking news, wow, put it on, let me see what is the breaking news, something that's going to affect the markets, fine. But I don't think the repeat of what's going on Bloomberg or CNBC, and not labeling any of those as bad, but just that noise of constant, hey, feeding you stuff, feeding you ideas, it's too much. Streaming news as well. Now, I think these are great services. I think they can be very, very useful for breaking news. They can be very useful for data, can be very useful for this kind of stuff. But I think, like a lot of things, guys, 90% of the time, it's noise. You want to be tuning into these things, if you use them, just 10% of the time. So you want all inventories out. You want to see if the market suddenly spikes up, you want access to that streaming service. You can just unmute it and go, hey, well, there's rumors of X, Y, Z. Fine. If you're that type of trader, that's great. But for most people, that's just too much noise. Eliminate that noise. You don't need it. Third thing is other markets. We have a tendency to go, well, I'm trading SPOOs, I'm trading NQ. Well, obviously I don't want to have Dow up there. I must have gold. Oh, I should have bonds as well. You know what? Maybe I should have some of the top tech stocks because that makes sense. Also maybe see what Europe's been doing. I could have currency pairs, and before you know it, you've got all these markets there. And if you're really going to not make a decision to trade the S&P 500 based on what yen is doing, probably not. Unless, of course, yen is the engine of the market. Now, there are times when you might say, what are you talking about, Mark? Well, sometimes we have this cyclical nature where there's one asset class that can be the engine of the market. It's we either have a news engine, which is the news story driving stuff, it's coronavirus recovery, vaccine, all that stuff at the moment. Maybe it's pumping money in from the Fed, maybe it's the government, then maybe it's gold doing this, or oil spiking, or some crisis in Japan. There's always a news story that's the engine of the market. So unless it's the engine of the market, I don't think there's any point in doing that, or unless, of course, you have some kind of system that relies on a correlation between two assets. I know a very good trader who used to trade very successfully pairs of Dow and FTSE, DAX and FTSE, and play that game. And so we'd obviously have those markets up on his screen, and you understand the nuances and the intricacies of that. Fine, if that's your strategy, fine. For most people, purely directional players, You don't need to know these markets. It's just adding extra noise. So get rid of them. Just focus on the markets that you're trading and maybe one other if that's a market you also like to trade. Tips. So I'm talking here about newsletters, tips and stuff. Now listen, if you use them as a kind of going off piste a little bit here, but let's say you use those to put into a watch list to watch. That's fine. That's a process of bringing interesting stock ideas or trade ideas into your kind of scanning tool or into your kind of monitoring area. Fine. But if you're constantly allowing these to kind of jump into your inbox and this, that, the other, and someone sending alerts and it's not part of your system, it's just going to add noise. Multi-timeframes. So let's not confuse this with correct. I don't use the word correct, but let's say structured multi-time frame trade analysis. You're starting on your daily, going down to your hourly, your 15, your 5, pull the trigger on a 1, for example. That's fine. That's part of your plan. 100% carry on with that. But the danger we have is we look at one time frame or two time frames that we're making a decision and we go, oh, let me just check this time frame. Let me just check the lower time frame. What's the 1 minute doing? What's this doing? What's that doing? If that's not part of your decision-making process, don't bother adding that extra pressure on you. If you don't care what the 1 minute's doing, don't look at it. If that has no impact on your decision, don't look at it. Reduce this multi-time frame to the time frames you want to look at. Your higher, your medium, your lower, if that's the way you operate, or your higher and your medium for swing trading, whatever it is. Note down, but don't get deviated and distracted into different time frames. It's just noise, noise, noise. Penultimate one, guys, indicators. Now I get some heat for kind of going this anti-indicator. I'm not anti-indicators, I use them, and if you guys have done the course, I'd share very freely a couple of strategies that they are reliant on indicators as a trigger to get in. I just don't like to use them a lot because I personally prefer to just read and feel what the market's doing without that. Now, there are many successful traders out there who use indicators, but this is where the kind of the complexity comes in and where the distinction is. Those guys who are using indicators and are doing very, very well and having persistent 7-figure years are the people who know exactly what they're looking for and the indicator helps to guide them. It doesn't mean if you put indicators on, you're never gonna have a 7-figure year. No, it doesn't mean anything like that, of course. But the difference is a lot of traders put on all these indicators and it just adds noise and complexity. Ultimately, if your market's driving higher and it's pulling back, if you've got some indicators saying, oh no, it's overbought, it's just the most useless indicator at that point in time. It's overbought. It's a momentum type aggressive trade. You want to get on board, a little pause, little pullback, stretch the spring, contract kind of thing. So I don't have anything against indicators at all, but when you've got them all over the place and you're kind of looking at every single indicator to line up in this, that's just noise. If you must have indicators on, I'm definitely a fan of naked charts, pure price, finding a setup and strategy, adding an indicator if you want help guide you to that, like my 3-minute cycle trade, my first pullback type trade, the kind of momentum ignition afternoon predator strat, all this kind of stuff. Fine, but if you're using them to far too many, it's going to cloud your decision-making process. It's going to be difficult to make a decision because well, stochastic says this, moving average says this, and Bollinger Bands are this, and and it's just going to. And then when you've got all this other stuff, the news is saying this, news is saying that we're overvalued, and then some kind of hedge fund manager comes on and says, hey, we're in a bubble. Another hedge fund manager comes on and says, yeah, we've got another 2 years of rally, and you're like, oh, what do I trade? And it's very difficult to make a decision. And when you do make a decision, this is the key, guys, you don't have the confidence to hold the trade because you're thinking it could go anywhere, this thing. I don't know if I'm a long and I should be staying in it because this guy says it's short. My indicator says it's short. The other markets are saying it could be short. The correlation's broken. And you just end up adding no confidence to your ability to take a trade. So indicators, pare them down at the least, and if possible, remove them, see how you get on with that. So taking rid of those. And opinions as well. Listen, opinions are fine, but at the end of the day, everybody has an opinion, and generally people can articulate, an intelligent person can articulate an opinion against or for your trade idea very, very easily. And it's hard to differentiate and go, well, yes, the bear thesis is valid, the bull thesis is valid, which is right. You have to form your own opinion and stick to it. So, and the opinions as well, I think that if ultimately someone says, oh, this is going up, it's definitely going up, and you think it's going lower, and you're like, oh, well, should I hold it? Should I not hold it? And it's quite difficult then to counteract that and have the confidence to hold the trade and all these other things. So eliminate the noise in your trading, guys. These are some of the main things that I consider to be noise. It means just getting rid of stuff that you just don't need to make your decision. Pretty simple. All right, guys, take care. See you next one. Bye-bye.